Hey, it's Jim, and this is FRM Part 1, the topic on financial markets and products, and the chapter on pricing, financial forwards, and futures. I'm going to begin with two examples that might take a bit of time, but bear with me because I think it's worth it as you look through these learning objectives. And I'll go through those here in just a second. But what I want you to do is let's pretend that I'm Jim and I'm a farmer. And I grow and sell grapefruit. Not really meaning to be a prop professor, but I'm also an investor and I have a share of stock right here. It's just a little index card. So I want you to think about what's going on here. There's a spot market for the grapefruit. Let's suppose it costs $1 for a grapefruit. So I'm growing my grapefruit, I'm picking them off the trees, and I'm selling them for $1. But you come to me and you say, you know what, Jim, I really want your grapefruit, but I don't want it for a month. You could have tons of reasons for wanting this, demanding this in a month. So I look at you and say, well, you know what? I can sell it for $1 right now. I can sell this grapefruit for $1. How much are you going to agree to pay me in a month? And your first reaction is probably going to be, well, how about if we just agree on $1? But I'm going to say, whoa, I'm going to say, wait a minute. If I have this grapefruit right here, I'm going to have to put it over there and save it for you. And putting it over there means that I'm going to have to pay for storage costs, and I'm going to have to pay for insurance costs, and probably a whole bunch of other costs that we can talk about in some other recording. So let's suppose that we agree on, let's just say $1.20. So what happens is that we agree that in a month's time, you'll come back, you'll hand me $1.20, and I'll go into my refrigerator or whatever it is, and I'll hand you that grapefruit, and we'll both be satisfied. Now today, after we sign this contract, this forward contract, here's another envelope here. So this is a derivative security. We agree, you sign it and I sign it, $1.20 for a grapefruit in 30 days. And of course, there's probably some quality agreements there. I mean, it can't be mashed. There can't be ants crawling all over it. So once we agree on that, we have a derivative contract. But when we're having that conversation, you look over here on my desk and you say, hey, I see you have a piece of paper over there. Isn't that a share of stock? And I say, oh yeah, that's a share of stock in Jim's Concrete Company. That the price is $100. I'm thinking of selling it. And you say, well, I don't really want that today. But when I come back in a month, how about if I pay you to take ownership of that share of stock? And I'll say, well, that price today is $100. How much are you willing to pay me in 30 days? Well, it depends on what you expect and what I expect the price of Jim's Concrete Company to be in 30 days. Now, if you say, and we agree to a contract that you want to take ownership of this piece of paper, I don't have to pay for insurance, and I don't have to pay to store it. But I am worried about an interest rate. Now, remember when I said about the grapefruit that there might be some other costs in there? Well, let's throw an interest rate in there as well. But primarily in a financial forward contract, we need to worry about interest rates. So let's suppose that we agree on $120. So a month from now, you bring me $1.20 for the grapefruit and $120 for that share of stock. So now we have two derivative contracts, two pieces of paper. Here we have the spot stuff, right? Here's a share of stock. I could take this to the New York Stock Exchange and sell it. Here's my grapefruit. I could take that to the farmer's market and sell it. But now we have a derivative security, okay? Now, here's the next question. The next question is, what happens to the value of these derivative securities over the next 30 days? And the answer is, it depends on the spot price of grapefruit and the spot price of the share of stock in Jim's Concrete Company. If the price goes way, way up, suppose the spot price for grapefruit is $3 in 10 days. I'm going to be so upset. I'm going to say, wait a minute. I agreed to sell you this grapefruit for $1.20. I could sell it right now for $3. So I'm not going to be happy, but you're going to be super happy. And the same thing with the share of stock. So the value of this derivative contract depends on the underlying asset value. All right, how about that? How long did that take? 3 or 4 minutes? Was it worth it? I sure hope it was worth it. So we're going to define and describe financial assets. I just did that. And we didn't do any short selling. That's super easy. So difference between forward and futures. We have a slide for that one. That'll be super easy. Calculate forward price. There's that $1.20 for the grapefruit and the $120 for the share of stock. and then distinguish between the forward price and the value. That's this thing right here, the value of that forward contract. And then we're going to go ahead and calculate the value, and then we'll do some arbitrage stuff. We won't use a share of stock, we'll use a stock index. So there we go. Sounds to me like we could just turn the recording off. We know all those learning objectives, but maybe not. Maybe I have some interesting things to say. All right, I'm really fascinated by the chapter here. Remember, this is a chapter somewhere in the middle of this entire topic, and the authors then go ahead and ask the question, what is a financial asset? So I was thinking to myself, boy, shouldn't this have been all the way back to the very first conversation that we had? And of course it is, but GARP felt it was super important to just remind you. So what's a financial asset? It's a tradable investment representing ownership or claim on the future cash flows or income from some kind of corporation or business or organization. All financial assets are investment assets. All right, so I want you to think about it in this context. You know, you guys have your lifetime portfolios. So what do? You take that money and you go ahead and invest it. Maybe you invest it in shares of stock. Maybe you invest it in an alternative investment, or maybe you invest it in fixed income securities. And so what do? We do all that stuff so that we can generate a positive return, so that we can consume more in the future, right? We want to save today so that we can send our children to college, so that we can buy a lake house or a beach house, or so that we can buy a seat on the space shuttle. Whatever that is, we have lifetime goals. So financial assets are the means so that we can achieve those lifetime goals. So 3 different types. Some provide no income, like a non-dividend share of stock. Some provide a fixed income with a known amount and a fixed amount, like a fixed coupon paying bond. But then some assets provide a known income from a percentage of their value. Short selling, this is really a super cool concept, and it's super easy. What do we know? We know that we want to, let's go back to my example here. We want to buy at 100, right? That Jim's Concrete Company, and we want to sell at 110 or 120 or $150, right? We want to buy low and sell high. Well, short selling is the exact same goal, buy low and sell high, but we reverse the process. We sell something first at a high price, and then we expect the price to fall, and then we buy it back at that lower price. Just to remind you that when we go to the floor of the New York Stock Exchange and we buy this share of Jim's Concrete Company for $100, and then we sell it a year from now for 130 or 150, that's the long position. Long position benefits when the price of the asset rises. Well, the short position does just the opposite. It benefits when prices fall. So your first question ought to be, well, how do I sell something if I don't own it? And that's a great question. And the easy solution and the easy answer is that, well, we just borrow it. The rules historically have been that whenever an investor buys shares on margin, you give the investment firm the right to lend those things out for short sales. So you just call your investment banker and say, hey, I want to short shares of Jim's Concrete Company. And the investment banker will look at his or her inventory of margin shares and say, oh yeah, how many do you want? Here. So you take those shares and you sell them. Now, of course, when you sell them, you generate lots of income. And what the investment banker is probably going to make you do is keep all or at least some of that money on account there, just so that you don't. Think about it. I could say, hey, I want to short $1 trillion worth of Jim's Concrete Company, so I get $1 trillion today, and then I go move over there where nobody can ever find me. So to prevent that from happening, you got to keep these. You got to keep most of your short sale with the investment banking firm. Of course, there are different kind of rules and regulations. It depends on your net worth. So what we do is we sell it, then we hope the price falls. We repurchase those shares, and then we return them to the investment banker, who slips them right back into the account from that margin account. So the margin people, they have no idea that their shares have been lent out. And that's going to be an important concept here. Look at the second part of this learning objective of a dividend-paying stock. All right, so everybody get this. So when you take the long position, you buy now and you sell at a higher price later. When you take the short position, you sell first at the higher price, hoping that the price falls. Short and long position. Now let's go ahead and ask ourselves the question, all right, suppose we do this, then do we make any money? So the first assumption in the chapter is that there is no borrowing fee. So what we're going to do is we're just going to compute our initial sales revenue, right? We sell the shares and then we generate income, right? Revenue, and then we repurchase them. And then the short sale profit is just going to be the difference between the selling high, say that's 150, and the buying low, say that's 50. So there's $100. That's our short sale profit. But remember what I said, that those margin people over there, they don't know that their shares have been lent to us as the short position. But when the company pays a dividend, that company is going to pay the dividend to whoever we sold the shares to on the floor of the New York Stock Exchange, which makes us reliable for making that dividend payment, right? So that margin account, that individual shareholder, they are entitled to that dividend. And so the short sale means that we have to pay for that. So look down at the bottom. There's a good formula to remember. Short sale profit minus dividends and any borrowing fees and any interest expense. A lot of times in these professional exams, the test creators just assume borrowing fees are zero and that there is no interest expense. But if there is, you could easily calculate it. So let's do just a quick example here. So we're borrowing 1,000 shares. We sell at 50. And then we buy them back at 40. So there's $10, right? Everybody get that? That's a $10 per share profit. But we have to pay the dividend. That's going to be a separate transaction. We pay the dividend. So that leaves us with $9. All right, so doing this in terms of 1,000 shares, we get the short sale profit of $10,000, and then we have to make the dividend payment of $1,000, which leaves us with just $9,000 profit. So that makes sense. $9 per share, 9 times 1,000, that gets us a $9,000 profit. Now, of course, note that here in this example, and the one that's in the chapter, everyone's happy, right? We make money, we make $9,000, but of course the opposite can occur. So be prepared for that net profit to be negative in an exam question. All right, how about the next learning objective? Differences between forward and futures contracts. All right, you ready for this? That the forward contract can be tailored, right? We tailored it to my grapefruit, and we tailored it to Jim's concrete company, and we got these forward contracts. So that's what a forward contract is. It's unique. It can be tailored to the needs of both the buyer and the seller. So I could come in and say, you know what, I want to sell 487 grapefruit, and I want to do it on January 27th, right? So that's tailored to the unique needs of the client. And of course, the investment banking firm, when I go to them and say, will you write this contract? I mean, they don't say no, right? That's their job. They say yes. Now, of course, they may charge me for that if it has no liquidity or if it has lots of risk, but that's a conversation for a different day. Futures contracts, on the other hand, were created essentially here in the United States, 1848, by 12 dudes in Chicago who said, you know what? The unique aspect of forward contracts, it's great. But when somebody wants to get out of that contract before the maturity date, there's no liquidity. It's very difficult to sell a forward contract. So a futures contract is nothing more than a standardized forward contract that's traded on an exchange. And then here's the key part. It is characterized by marking to market. That's the big difference between a forward and a futures contract. So just remember this for the exam. You'll get every question right. Futures contract, standardized forward contract, trading on exchange, mark to market. How about the second part there? Explain the relationship between forward and spot prices. Well, that's what I said earlier. What was the spot price of this? That was $1. What was the forward price? Well, that was the $1.20. See, I told you to pay attention early on, and that would lead you to success in understanding these these learning objectives. Now, what's the difference? The difference between a forward and a spot price for commodities like grapefruit has everything to do with things like storage fees and insurance cost plus some interest rate. Now, for financial futures like Jim's Concrete Company or the S&P 500 index forward or futures contract, we're worried about interest rates. And it's going to be a risk-free rate of interest, and I'll explain that here in just a little bit. But also think about this. Here in the spot market, we have supply and demand conditions for trading a share of stock and a commodity today. But in the derivatives market, we have a contract in which we are exposed to future or expected supply and demand conditions. And so the difference between supply and demand today and supply and demand in 30 days, using my earlier example, is going to illustrate the difference between forward and spot prices. Here's a great slide that we have prepared. Get out your phone, take a picture of this, and this will be able to help you answer almost any question on addressing that learning objective, difference between forward and futures contracts. Two quick examples here. Forward contract example, Tesla battery, 2020. When you sign this forward contract, what's happening is that you are, and I said this earlier, you are eliminating or at least substantially reducing commodity price risk for the grapefruit and stock price risk for the share of stock. Here, what Tesla is trying to do is trying to manage their inputs. This is great capital budgeting stuff, right? So what do? They buy cobalt, whatever that is. They have to put it in a battery, so they get it and they throw it in the battery, however that works. And so what could happen? I mean, the worst thing that could happen to Tesla is that the price of cobalt goes from whatever it is today and it doubles or triples, right? And then all of a sudden a Tesla car becomes priced too high for its target audience. So here's an example of, let's call this a commodity forward contract with cobalt. And then Southwest Airlines here with a futures contract using oil futures contracts. And so what does Southwest Airlines do? They buy fuel every day, right? They got to put it into the airplane so that they can fly. So what's the worst thing that can happen to Southwest Airlines is that the price of oil goes from $50 or $80 or $100 a barrel to $200 or $400 a barrel. And then all of a sudden they have to try to pass that input cost onto their passengers. Sometimes it works, sometimes it doesn't. But what does Tesla do back here? They locked into a price of cobalt, therefore eliminating commodity price risk. What does Southwest Airlines do? They lock in to a future buying price of oil so that they can substantially reduce their commodity price risk and lock in. And so this does great things for their capital budgeting, for their estimation of operating cash flows, and it's a great risk management tool. All right, here's a formal equation that summarizes what we talked about in the very beginning. So look at the red box there. What is the forward price? It's equal to S, which is the spot price. And we're going to compound that out, 1 plus some kind of an interest rate raised to the T power. So this is a super simple math. Notice that the learning objective is to calculate that forward price. So you have to be given a spot, you have to be given an interest rate, and you have to be given time. There's a super simple example down at the bottom where you can go from $100 out to $110.25. Now, that annually compounded risk-free rate, this formula here is probably what you're going to get on the exam. It's probably limited to financial futures contracts or forward contracts. Now, here's this concept of arbitrage. We know this from previous conversations. What is arbitrage? It means that you can buy in one market at a price and without any risk, take it to another market and sell it for a profit. So suppose that you paid me $1 for this grapefruit, and you knew that you could walk across the street and you could sell it for $1.10. So you pay me $1, you get the grapefruit, and you run as fast as you can over across the street, and you sell it for $1.10. There's a 10-cent arbitrage profit. Now, do these things exist? Absolutely they do, but they exist for relatively short time periods because remember, I'm not the only grapefruit farmer. And so by the time you pay me $1 and run across the street, there might be somebody who's faster than you are who bought a grapefruit for $1 from my neighboring farmer, and that person ran across the street faster than you could and sold it for that $1.10. So you were out that 10 cents, but that guy, he got the 10 cents of arbitrage profit. And so really that's kind of a silly example because it really doesn't depend on how fast you can run, but it depends on what is your algorithm inside of the software of your computer to be able to take advantage of this arbitrage opportunity. So let's do a little bit of math here. So what do we know? We know, and let me just go back here quickly. We know this is in the red box, this is the theoretical forward price. So we start with that, but what we know is that maybe that forward price deviates from the actual price in the spot market or in the futures market or forward market. So let's work through a cash and carry arbitrage. So cash, what does that mean? Cash, we're doing some cash and then we're going to carry it. So, get out your muscles. We're going to carry this grapefruit or we're going to carry this share of stock. All right, so if the forward price is higher than the expected future spot price, now, of course, we need to adjust. Notice there in parentheses, there's the storage, there's the interest, there's the insurance. Boy, I talked all about this in the beginning. Didn't I tell you to pay attention back then? All right, so what are we going to do? We're going to borrow at the risk-free rate. And this arbitrage strategy assumes that we can borrow at the risk-free rate. Now, you and I might not be able to borrow at the risk-free rate, but those of you who work in the financial institutions industry, either you're doing this or you have colleagues inside of your institution who are doing this. So think of these massive banks and bank holding companies. Of course, they can borrow at very low interest rates. So we're going to buy the asset in the spot market. We're going to go ahead and short the forward contract, hold the asset until it matures, and then deliver the asset against the forward contract, and there'll be a price difference in there. Now, what we can do is just the opposite. Suppose if the forward price is lower than the expected future spot price. This is the reverse cash and carry. So we're reversing, like we switch it upside down and have someone else do the carrying. So here's the process. We're going to short the asset and we're going to buy the contract. And then we're going to use the proceeds to invest in a risk-free rate. Just think about buying a treasury security. And then we're going to buy the asset at the forward asset, the forward contract's maturity, profiting from the price difference. So let's go ahead and work through these examples. So here, let me just go back quickly here. So this might seem a little complex. Oops, I went too far. That might seem a little complex, but don't worry about it. You'll get this so easily when we work through this example. So here we have spot of 100, forward price. So this is the observed forward price, 110, 5% interest rate, 1 year, $2 in carrying costs. So look at the very bottom, calculate the expected future spot price. So how are we going to do that? We're going to take the $100 and we're going to compound that out at the 5%, and then we're going to add the $2. So there we go. There's the expected future spot price of $107. So how are we going to take advantage of that? Well, what do we know? Let me go back here. The forward price is 110, but that theoretical, that theoretical value should be just 107. All right, so what are we going to do? The forward price is greater than the expected future spot price, right? Forward price is greater than that theoretical value. So we're going to borrow 100 at the risk-free. We're going to buy that asset for $100. We're going to short the contract for 110. We're going to hold the asset for a year, right? But we're going to incur those carrying costs, right? Remember, we got to put it in a refrigerator over there and pay for insurance. And then at maturity, we're going to go ahead and deliver the asset. So what's the profit? Well, we sold the asset for 110, right? And what do we have to pay at maturity? The $100 plus the 5% minus the $2 of refrigeration costs over there. And there we go, $3. This is a risk-free arbitrage profit. Now, what if the reverse holds true? That's why we call it a reverse cash and carry. So let me go ahead back here. Notice well, where was I here? Here's the example. So spot was 100. Forward price is 110. All right, so that's going to be our cash and carry. Now, in this next example, we have the spot price is 100 and the forward price, boy, we made a really obvious example here of having the forward price of 95, still 5%. Storage and insurance still $2. So let's go ahead and work through the math again. So there's the same 107, right? But now it's 95. So here we're going to make a bunch of money, right? So we're going to short the asset for 110, take the long position in the forward contract for 95, and we're going to go ahead and invest, right? We're going to invest and we're going to earn $5. At maturity, we'll buy that asset for 95 using the forward contract, and then we repay that short position with that $5. So what do we have? We got the 10 plus, the 100 plus the 5 that we get on the risk-free, right? Minus the 95 from the forward contract. There's our $10 in an arbitrage profit. Now, when I'm making up these questions for my students, I try not to make them super obvious so that the students know exactly what's going to happen. Now, back here, where was that example? Yeah, back here in this example, when you look at this, the question stem, and well, here it is right here. We know there's 100 and 110, so we know that's 10%, and the risk-free is only 5%. So we kind of know this is going to be cash and carry. With the second example, well, we knew this is going to be the reverse cash and carry. So my point is that if I were making up this question, I would probably change this forward price to not be 95. Maybe I'd change it to, 101 or something, just to make it so that when you look at it, you're not quite sure what that answer is going to be. That's why, and the chapter does a great job of this, and we do a good job here of illustrating this. Go ahead and, what's that first thing down at the bottom? Calculate the expected future spot price adjusted for carrying costs. All right, here's just a quick illustration of what we talked about here. Forward price, so it starts over here at the spot, and then we go up the hill, and there's the forward price. Look at that third bullet point down there. There's no initial cash flow, right? When we signed this contract for the grapefruit or the share of stock, no cash changed hands and no underlying asset changed hands. What that means is that the derivative has an initial value of $0. Now, of course, this is going to be based on the spot price and then the storage costs, we talked about that, and time, but also the risk-free rate of interest. Now, the chapter doesn't get into hardly any detail about why we're choosing the risk-free rate of interest. And there are a handful of reasons of why we're doing this, not least of which is that example that we just went through, that you can use the cash or you can use the reverse cash and carry model to generate a risk-free outcome, risk-free positive rate of return. And so you really have to go back to around 1970, Fisher Black and Myron Scholes and Robert Merton. They developed this Black-Scholes-Merton option pricing model. And they were about the first people who decided that, to value a derivative, we need to use the risk-free rate of interest, or at least start at the risk-free rate of interest. So make sure that you're not confused about, the riskiness of this sounds pretty risky, but no, of course. Because you can use derivatives and you can use spot assets to form a risk-free portfolio. So just remember that's the risk-free rate. All right, so this is, I think, where it gets even more interesting. What is the value of a forward contract over the course of the lifetime? So let's go back to this thing here. What did we agree? We agreed to trade this grapefruit at $1.20. What's the value of this piece of paper? What's the value of this derivative security between now and 30 days from now? Well, suppose the price of a grapefruit goes up to $3. And what did I say just a few moments ago? I'm not happy at all because I agreed to sell you this grapefruit for just $1.20. Boy, if I defaulted on that contract, I could sell it for $3. Oh, I'm super unhappy. But what you could do is you can sell this derivative contract to reflect the price movement that was in your favor and against me. So now do you see the great difference, extra great difference between a forward and a futures contract? If this is a forward contract, which I think it was in the beginning of our discussion, then in order for you to sell your forward contract, you're going to have to find somebody to take over. That might be super difficult in the forward market. But if this is on an exchange, like the Chicago Mercantile Exchange, you're going to be able to sell this derivative security like that, and you'll be able to realize that profit. You don't even have to wait until the maturity of the contract. And so this swings us back to what is discussed in the very beginning of this chapter. Look, what you and I used that original forward contract for was for hedging purposes. At least I did explicitly, maybe you did implicitly. So hedging is a great demand for forward and futures contract, but also for speculation. Look, I could have sold you this forward contract, and I didn't even need to be Jim the farmer. I could have been just, Jim the college professor, and I think that the price of grapefruit is going to move in a direction, and so I'll just go ahead and sell this forward contract to you. So remember, hedging and speculating and arbitragers, they operate inside of this derivative market. So back to our discussion here, how do we value this piece of paper, this derivative contract? Well, there we go. Look at the key characteristic. Changes over time because spot price changes and interest rates change, can be positive or negative, and it's zero at contract initiation. I want you to think about this. When you're worried about positive or negative on the exam, just think about whether you're happy. If you hold this piece of paper and the spot price of that grapefruit is $3, you are so happy. You're prideful, right? You have a sense of pride that you signed that contract. Me, I'm so depressed, right, that I have to sell you that grapefruit for just $1.20. So I have regret. So positivity and negativity, they have everything to do with your feelings or my feelings of pride or regret in signing that contract. Here's just a quick illustration of what we've been describing here. Initiation value is at 0. Over the life of the contract, the value is going to be probably positive or negative. And then at maturity, we go ahead and agree and exchange the asset for that agreed upon price. Now, let me go ahead and warn you this. I tell my students this all the time, and it takes them a while to get to understand this, that the overwhelming majority, 98% or so of all futures contracts are cash settled, because it's just way easier for me to reach into my wallet and hand you a bunch of money, or for you to do the same to me, rather than for you to take delivery of 1 million of these things, right? Or even just one. You got to get in your car and you got to drive over there to take delivery. I have to get in my car and I got to drive over there to provide delivery. It's a lot easier if I just have you get out your Venmo and I just go ahead and say, all right, I owe you however much that is. Let's go ahead and work through just a quick example. We have the same market data from before, $100 spot, forward price is 110, but now let's jump 6 months in advance. So we have a new spot price. Now the interest rate stays the same, but our time to maturity, which used to be a year, now is only half a year. So let's go ahead and calculate the value of that forward contract in 6 months. So let's start with that expected future spot price. So where we used the spot of 100 back in our original calculation, we did that a couple slides ago. Now we're going to substitute the current spot price. There's the S sub T. The 105, compound that out at 5%, but now we're only doing it for 6 months. So there's our new spot price. There's our new expected future spot price of 107.59. So let's go ahead and calculate the value of this forward contract. So remember, in my grapefruit example, it was $1.20 and $3. So there was a $1.80, but we need to take the present value of that difference. So that's all we're doing there. So we take the 107.59 minus that forward contracted price of 110, and then we discount it back 6 months at that 5%. So we get a minus 235. That's the negative value of the long position. So make sure you get that. Of course, the value of the short position would be a positive $2.35. So when you're on the exam, make sure that you answer the question that is being asked. The GARP has to say, calculate the value of the long position or calculate the value of the short position. One will have a positive sign next to it, and one will have a negative sign next to it. Now, of course, what we just did is we computed the value of a forward contract that does not have any income or yield. Well, let's suppose that we do. So what happens if we do? We need to figure out how to consider that income. And this is why the Institute gives you that short position there example in the very beginning, and why I went through the example with the dividend. So remember now, when you're in the derivatives market, you're going to be responsible for making that dividend payment, or maybe it's an interest payment if it's an interest rate forward contract. So just very quickly look at the red box. There's the spot right there, but notice we're subtracting an I. Look at the orange bullet point, the present value of the known income, which of course could be a dividend payment, or could be an interest payment. And so look down at the bottom blue box there. All we're doing is taking that present value, just like we always have done. So let's take a look at a quick example. So we have a share of stock for 100, dividend $5, dividend payment in a half a year, risk-free 5%, forward contract is 1 year. How do we come up with what is a reasonable estimate of the value of the forward contract? Well, let's first take the present value of that dividend payment. So take the 5 and divide it by 1 plus the risk-free rate of interest. Once again, raised to just that half year because we get that dividend payment in a half a year. So there's the $4.88. Take that out of the $100 spot price and then compound it out. There's the forward price, $99.88. Now, we can also do this in that third example that we had just a few slides ago. What happens if the income is expressed as a percentage of the price of the asset rather than what we were given in that previous example? What we were given? We were given the actual dividend payment. Suppose we're given a dividend yield, or a coupon yield, or a bond yield. And so the formula looks exactly the same, but instead we've got to do some kind of ratios here. So let's do a quick example. So we have $100, but now instead of a dividend cash payment, we have a dividend yield. Risk-free rate, time is still the same. So what we're going to do is we're going to simply take the ratio of those compoundings, right? So 1 plus 1.05 divided by 1 plus 0.03, right? So that we take that compounding ratio, and we get a forward price of 101.94. Now, what happens to cash and carry and reverse cash and carry if we have to make this yield payment? Well, we're going to do the same thing. And we're going to do the same thing here for cash and carry and reverse cash and carry. So let's just go ahead and work through an example. So here's the spot price, 100. There's our 3%. There's our forward price, 104. Notice we have in parentheses there, if you had forgotten it, that is missed price. So determine if an arbitrage opportunity exists. Okay, if so, calculate the profit. See how clever we are. But look, the fact that we have the 104 in there that tells us that it's missed price, clearly the GARP is not going to give you the signal that it is missed price. So there we go. There's our 101.94, which we calculated before. That's why we have missed price there. So 104 is greater than 101. So this is cash and carry, right? The forward is greater than that expected price. So how do we do this? All right, we're going to do the same thing that we did earlier. We're going to borrow 100. Remember, we're assuming that we can do that at the risk-free rate. We're going to buy the stock for $100, short the forward contract at that higher price, right? We want to short it. We want to sell at the higher price, knowing that it's overpriced. Collect the dividend yield, deliver the stock, right? So 104 minus the 100 times 1 plus that risk-free rate. And then there's that 3% of 100, right? That's the same thing as a $3 coupon dividend payment. So that gives us $2 of a risk-free arbitrage profit. Now, we've pretty much covered this slide here, explain the relationship between forward and futures prices. What did I say earlier? Futures contract is nothing more than a standardized forward contract in which it's traded on an exchange, and there is marking to market. So what are those things that we need to consider? Well, we need to worry about cost of carrying. we need to worry about marking to market. So look at that bottom teardrop point. Futures contracts recognize an immediate profit or loss, while the forward contracts only recognize the present value of that profit. Now remember, in the futures market, you are forced to do this daily settlement. I use this example multiple times. Maybe you've heard this before, but it's worth repeating. At the end of that great movie of Trading Places, Mortimer and Randolph Duke, they have just lost $394 million. And they say, turn those machines back on. And the exchange president comes over and says, we settle accounts every day. So that's immediately. Now, in the forward market, the only time you realize that is if you want to get out of the contract. Otherwise, you have to wait until the end. But we can value that contract using the present value of that profit. And the reason that we do that is so that you know what the present value of that forward contract is, so that you can use that as collateral if you want to borrow money somewhere else. All right, so let's look at, instead of just Jim's Concrete Company, let's suppose that it's a piece of paper that's a derivative for the entire S&P 500 index. So there's an equation that we've just had, priced just like forward contracts, where the underlying pays a dividend. All right, so here's where we go. 3,000 is the index level, risk-free rate 2%, dividend yield 1.5%. Determine the forward price. There we go. We're just going to measure the relationship between the compounding of the risk-free rate divided by the compounding of the dividend yield. So there we go. 3007. I can't help but refer what a cool forward price this is, because it reflects James Bond. So how do we take advantage of mispricing in the forward, or in this case, the futures market? Well, we're going to do the same thing that we did before. There's our arbitrage strategy. We work through those same diamond points. There's the reverse. We work through those same diamond points. So it should be fine. So there we go. We've done all of those learning objectives. What you can do now is make certain that you are familiar with all the terminology, because you need to make sure that when the GARP asks you about something, value of a forward contract at initiation, value during the lifetime, you know the difference. Remember, dividends and coupon payments, they impact the value of that forward contract. So this was super fun for me. I love talking about derivatives. So I hope you enjoyed it, and I hope it gives you a valuable lesson to have success on the exam. Remember, grapefruit. Hey, have a great day, and thanks for watching. Good luck studying.